I've discussed this before. I don't mind discussing it again. But Chuck here has a question similar to what Alice was talking about, but a little bit different. And I'm going to spend 5 to 10 minutes on this. He said 30 seconds. Nothing's 30 seconds when you talk about options, Chuck. Otherwise, you leave people with the impression they can do something. They go off and do it, and then they schedule a coaching session next week and tell me that, no, it did not work out as they expect. How can they repair it? In any case, 2 different discussions on this real quick, though, however. Chuck's asking about a collar position. That's where I do similar to what we were talking about just recently with the covered call position, but I'm going to buy stock, sell a call at or just slightly out of the money, and then buy a near-term put option that's out of the money, that's below the current stock price. So we have the potential to get the return of the covered call, but we're giving up some of that covered call potential return to buy an out-of-the-money put to create a structure where we can still make maybe 2 or 3% if we're assigned to the upside, but we can't lose more than 4 or 5% to the downside in that case. Let me change this here. This is the one I wanted to change in this structure. Put out of the money, good. Oh, sorry, put ask. Max risk, no. We're going to say max risk less than 6%. Monetary value doesn't matter, and the max return, I'm going to go 2.5. And we're just going to adjust this slightly, Chuck. All right. Where's a good price stock? They're all pretty decent. DR Horton, one I've been following, and once I close one of my Micron's a good price too. Crocs is a good price too. I want a good price, not a good stock. All right, I'm going to take the DHI position for Chuck's question. So what would a standard collar, what would I call a standard collar? This is not a radioactive trade where I'm looking for more growth and I'm buying a 5-6 month out put slightly in the money to have a lower cost per day and they work as a second asset. This is almost a fire and forget trade. I'm entering this position hoping to get assigned to the upside if DHI goes above 94.50 and I make a 2.7% return, but I have a max risk of only 2.2% on the position. Chuck's question, similar to what we talked about with the diagonal spread a moment ago, he says, what is your comment on using collars but substitute the stock with a deep in the money call with no extrinsic value? Number one, options that have no extrinsic value, meaning you have a delta of close to 1 that are far out in time, are very hard to get filled. There's no open interest on them. There's little to no open interest and little to no volume. Wider bid-ask spreads. Every time I've run an example for customers about instead of buying the married put, buying the stock and buying the 6 month out put, why not just buy a 6 month in the money call with a delta of 1 to create an in the money long strangle, but the delta is close to 1? It's because you never get filled on those. Very rarely do you get filled on those. At least I haven't. We tried to actually put in orders on Fidelity to get filled on those positions with a delta of 0.98 or greater, and they never triggered. They never triggered for us. But I wasn't going to pay the ask price because the bid-ask spread was way too wide, and then getting out of them is also a pain in the butt. I'm having a problem with that right now. I have trying to roll down a put on Ritchie Brothers. The stock's down to 59. I'm holding a July 70. Is it June or July? I think it's July 75 put. I've been trying to sell to close that for almost a week and not getting any fills on it. I bought it as a married put. I got filled on it. I'm trying to close this sucker. And what they want between the bid and the ask is absolutely atrocious. And there is no way I am going halfway between the midpoint and the bid price because that's less than intrinsic value. No, I am not selling a put option for less than intrinsic value. I've put it 5 cents above intrinsic, 10 cents above intrinsic. It's not filling. Those are some of the risks. But what does the structure look like? Well, looks pretty much the same. Let me head to the option chain first. And let's give ourselves, let's not use the same expiration. Let's go out. We were looking at the July, I believe, 35 days out. Let's go to November. Let's go to the large chain here. Time value. Where is, I know I have it. Well, that's pretty close. Yeah, see, these aren't even, there's some time value remaining on this. 16 cents, 17 cents. I don't have the time value, but the naked yield is pretty much the same. The time value is still at 0.3%, 0.4%. You're at a delta of 0.96. So the 42.50, if we're lucky to get midpoint at 50.35, that would be 52.85. So still about 30 cents of time premium, 0.3% on that position there. But let's do it. 42.50 at 50.35. That's the lowest strike. We're looking at all available options for November. Nothing at a delta of 1, nothing. I know what you mean, Chuck, but nothing with an extrinsic value at 0. Okay, it's still at 0.3, 0.4, 0.5. Adds to the risk. Even here, the 60 strike on the $92 stock is just a 0.9 delta. It still has 1.7% of time value. Oh, there it is. Yeah, 1.7% of time premium remaining on it. That's 50% in the money, isn't it? That's pretty close to 50% in the money. Yeah, 30. Oh, sorry, it's only 35.2. I'm sorry. But yeah, here 50% of the money, you're still carrying 0.4. But anyway, sorry, 42.50, 50.35. Let's substitute out our stock. And I have a feeling that this would be a similar situation, by the way, to what I'm experiencing right now. That looks a little bit different, doesn't it? Did I put a put in? Nope, that's a call. Oh, okay, that's why. What is going on here? What in God's great green earth did we just create? What you did here, I'm sorry, try to get a good view of it. What you created here, and the max profit is still, the profit value up here is still about 220, 223 in this case, okay? What you did here is it's not just an actual substitute. What you've really done here is created an in-the-money long strangle, but a diagonal strangle with the July 90 put, the November, July 90, the November 42.50 call, and then sold a 90 call against it. So if the stock goes down in this fashion, you're not losing one-to-one with the put. Eventually you hit a point where you could actually profit to the downside if it drops 60, 65, 70% of your profit, and you have an upside here as well. No margin requirement in this case. But again, you're saving some money because you're only paying about half the price of the stock to get as close to a delta as possible. You still keep the same relative upside return in this case. I just don't do it this way. And the main reason I don't do it is because when we talk about the married puts, where this is far out in time, and I'm putting the time value decay curve in my place and everything along those lines, Chuck, you got your 50 days there. When you substitute a long call for this, you create an in-the-money long strangle, which means you usually need a larger movement because you're not delta neutral. You are delta opposed. Okay, that's when these are both out 160 days, Chuck, 170 days, what we look for in the married put positions. In that structure, this is why I talk about a lot. I don't use it because you create an in-the-money long strangle. You're not delta neutral. You're more delta opposed. And now you need a bigger movement to the upside where the break even on the married put might only be a 4 or 5 or, so if this married put, moves up 2 points, I'm still probably making, $1.90 on the married put. I'm still making 50 to 60% of what I expected to make on the married put. The stock moves up $1 or $2 because of the structure. When I use a call that I can get filled on that has action and activity and not a wide bid-ask spread, that gets closer to being delta opposed, which means now if the stock moves up 2 points, I have a gain in my call, but it's almost equal to the loss. Every example we've run for these in the past, you need a much larger movement on the stock to see a profit, to start seeing a profit, liquidation profit on that in-the-money long strangle than you do with the married put position with the stock with a guaranteed 1 delta and the put option as well. And simulating that with the in-the-money long strangle, you usually need a larger movement. Now, you're right. If the stock jumps up 15%, I might only be at a 7.5%, 8%, 9% gain on the married put position. This is probably going to be a very high leveraged return once you see that move 15, 20, 30%. But that's not the kind of stocks I'm looking for with this structure. I'm looking for something that I feel has a potential to grow 10 to 12% in the next 8, 10, 12 months. Expecting 4 or 5%, maybe, hopefully, in the first 30 to 60 days. That's not a breakout stock. Okay, that's more of a longer term growth play is what the married put is, but converting it to an in-the-money long strangle puts you in that delta opposed position. This structure here, again, It doesn't look too bad if you could get filled on that price, if you could get filled near that price that we were talking about. Let's go back to the option chain real quick. I just want to see something. Look at these numbers. 0 open interest, 0 current volume, 0 previous. 0 open interest, 0 open. The first one with open interest is the 50 strike, which is still carrying a 0.3% time premium. That's not too bad. None here. Highest one in the money with the highest one before we get to others, and some activity. Some activity even today. You're looking at a 2.8 and 2.6% time premium, not a 0 extrinsic. Yeah, so there's no point here. Let's go to the 50 strike. I'm going to go to that call research that we were talking about before. Yeah, no listed trade time. Even though there's 2 open interests, it's been so long since this option has actually had a trade at a last price that it's not even shown across the exchanges anymore. Okay, it's not recording a last price because it's been so long since this option has traded. Even though there is an open interest.to, and this option hasn't been out that long. It's been out about 3.5 months, 3 months even. No, I'm sorry, 2.5 months. So it came out probably sometime around, yeah, there you go, 321, 322 in that case. So it's been in there, it's been available since March. But those deep ITM options, again, wide bid-ask spread, 4 or 5 points in some cases, 4 points, 3.5 points, 4 points, so on. Little or no activity. Maybe you get filled at a reasonable price. Then when you go to try to sell to close it to exit the position, much harder to get out of in those situations. Are the nearer terms better? If I tried to force it all together, we're looking at July. I'm sorry. Yeah, July 9th. Okay. So let's go to the July 9 series, 35 days away. Still, 2.7% time premium, 0.3, 0.4. No open interest, no activity until we get the 90 strike, which is not even that deep in the money. Bid-ask spread's much better, $2, $1, only 40 cents there. That's pretty good. This one's $1. No, it's a 70 cents. That's not too bad. 2 contracts traded today. But again, this is still for July, still a 1.8% extrinsic. 0.3% no trading activity, 0.4% no trading activity, and so forth. And then you even go to 1.4% no activity. So exiting might be a problem, even if you do get into the positions. You've got to watch that volume and that open interest. I'm not saying it's a bad idea. You are creating an in-the-money long strangle, which you can actually profit to the downside if there's a 50, 60% drop in the price. But again, I don't know. If your goal is to have a collar and have the single-digit risk, why not just stay with a standard collar and the proper position sizing and avoiding the lie of leverage? This does have some complications with getting a good fill price, getting the right prices, and we're still looking at relatively high amounts of time premium. Even we're not even going as deep in the money here. That's all the options that are available for July 9th. It only goes down to 75 strike, and there's no activity, and delta still 0.94, 0.95.